Over the last few years, supply and demand trading has become one of the most popular trading strategies, and for good reason because this trading style the best of support and resistance and adds the concept of the supply and demand. The result is a strategy that allows you to pivot point where the banks are buying and selling, giving you the chance to get into some of the biggest reversal before they begin. In today's video, I'm going to give you a full breakout of how to correctly find and draw supply and demand zones and the common mistakes you should avoid when trading these areas. News, events, economic announcements, and just general market actions all cause different groups of traders to buy and sell, resulting in a change to supply and demand equation. This change manifests visually as the rise, declines, and the consolidations we see on our charts. When we see price rising, demand overviewed supply. When we see price falling, supply overviewed demand. When supply and demand are in relative balance, consolidation forms. Change in supply and demand will only occur when the banks and other big traders buy or sell. We retail traders can't cause price to rise or fall because we don't have enough money. Only the banks with their high buy selling powers can make price moves. In Forex, for example, the banks can never place their full positions all at once. Their positions are so large they must break them into smaller chunks and place each trade individual around the similar price to avoid pushing price away and potentially forcing the entry and the bad price. This way they achieved the same effect of placing one huge portion by placing a bunch of the small ones instead. But there is the bank's problems. There is the positions that are often so big there are not enough people existence to opposite sides to get them placed buying when the banks want to sell, selling when the banks want to buy, even if they convert their positions into the smaller chunks. So they must let price moves away and then makes it returned later on to get the rest of the position entered. Now, supply and demand trading is all about finding points where the banks have bought or sold and then jumping into traders when price returns to pick up the rest of the bank's positions to get into the reversal right besides the banks. Supply and demand trading is the method where the idea is to find points in the market where price has made a strong advanced or declined and market this area as a supply and demand zones using rectangles. The point in which the price has made a strong advantage is marked by the trade as a demand zone. Demand zone represents points where the banks have placed a significant number. These are a support levels of the supply and demand trading, if you will, a point where the market has made a sharp decline is marked as the supply zone. These are points where the banks place significant number of sell positions, and these are resistance points where price could fall. Now, how to find and draw supply and demand zones. If you want to be successful trading supply and demand, you must master the finding of high probability zones and correctly drawing them on the chart. It takes time, practice, and experience to get this right. The most important rule is to look for sharp rise and decline in price. They reveal the banks are buying or selling, which means supply or demand must exist. At the source of the rise or decline, supply zones can located by looking for a swift drop away from either a signal candle. or the small consolidations structure, commonly known as a base. The base consists of the few candlesticks in thin sideways range consolidations. This is an example of the supply zone formed with the base, and this is an example of the supply zone formed from the single candles. Demand zones are found when the market makes a large move up from the single candles or the base. Here is an example of the demand zone created from the single candles, and here is an example of the demand zone with the base. And here is the first important point: the strength of the movement away from the supply and demand zone is not the determining factors in how strong the zone is, as long as zone has at least one large bullish or bearish candles moving away from it's considered just as valid for trading as a zone which has significant move away from it. And here's another important tip: supply and demand zones which are formed from a base tend to result in more successful trades than zones which formed signal candles. This is due to the sensitive nature of the psychology of the trade who had trading positions back when the base was created. A zone which formed with the signal candles means not a lot of the traders were caught on the wrong side of the market before the market moved up. In consolidations, before it begins advancing higher or falling lower, and when the market returns to a zone formed base, the trade who were trapped either long or short, depending on the zones, will begin closing their trades, and this creates liquidity in the market. Now we know how to find and locate supply and demand zones on our charts. We need to actually draw the zones, both signal candles, supply and demand zones, and the zones with the base are drawn in the same way. There are many different methods of how to draw the zones properly, but I will share the one I found to be the most consistent to me. We will begin by drawing a supply zone. So you always draw supply zones from the bullish candles before the drop. If the candles immediately before the drop is bearish, then you need to locate the most recent bullish candles and draw the zone accordingly. So the open of the bullish candles is where you want to begin drawing your supply zone from. Once you have done this, you need to draw the retracements up to the most recent high before the drop. Here are several examples of the supply zone. For demand zones, we draw the zones from the most recent bearish candles found immediately before the up move creating the zone. In this example, you can see I've drawn the demand zone from the open of the bearish candles found just before the market made this move up. For here, you need to find the most recent low nearest the zone and drag your retrace to the low. Now you have the demand zone drawn on your charts. Here are several examples of the demand zones. In contrast to when we are drawing supply zones, with candles you are drawing the demand zones of must be bearish. If it has to be bullish, you need to go back and locate nearest bearish candles before the move up and draw your vector from here. The reasons why is this important is due to how banks place trades. Banks do not place trades on the movements which are in the directions of the trade they are placing. Is simple terms. If the current candles is bullish, the bank won't be placing buy trades. If it's bearish, they won't placing buy sell trades. Before you start trading supply and demand, there are two key rules you need to understand to find the right zones on the chart and trade them correctly using your entry methods. First rule is that old zones rarely work. Apparently, the longer the market has been away from the supply or demand zones, are better chance the market has the turning when the eventually returns. This is completely wrong. Recent zones are far more important. If we compare the old supply and the demand zones, color blue, with the more recent zones, color white, it's easy to see how trading zones which have been created recently are far more effective than trading zones which were created a long time ago. Second rule is to trade only fresh, untouched zone. Another big misconceptions you will hear in the supply and demand community is the idea that the supply and demand zones have the power to cause reversal more than once, like support and resistance levels go. Again, this isn't true. Supply and demand zones are one-time use, not 2 times or 3 times, one time only. When price hits zone on the reverse, it's it. The zone loses its power. The probability it will cause another reversal in this future is low. The only exceptions to this rules is if a zone forms at the top of the bottom or the consolidations. In this case, price will probably reverse 2 or 3 times from the zone, since the consolidation shows the banks are buying 7 from its zero point. However, once the consolidations is over, the zone loses all its power and probably won't cause another reversal. Now, this was introducing the supply and demand trading, and it was impossible for me to cover everything about supply and demand trading in this video. In future videos we will go deeper and plan to explain several supply and demand trading strategies involving classic support and resistance levels, using price actions, patterns, and even trading indicators. As always, if you learned something new and found value, leave us a like to show your support, subscribe to our channel, and click the bell icon to stay notified when we release new video. Until next time.